It's another weekend and we're glad to have you join us on the program Capital Market. I'm Temple Ashaju. Thank you so much for joining us. The first half of the year ushered in high expectations as the previous year 2017 had shown some upside for the stock market, which closed as the third best performing market globally. This was driven by earnings fundamentals of companies, stability in the FX market, and of course, the fund flow dynamics to emerging and frontier markets like Nigeria. These factors characterized the first half of 2018, as we said, with huge impacts on the markets. But what's at stake for the second half of the year 2018? Investment firm FSDH Merchant Bank sees more upside after it published its report on the Nigerian economy tagged Conquering New Frontiers this week. The head of research at the bank, Mr. Ayodele Akinwumi, should be joining us much later on the program for some analysis on those projections. Meantime, let's begin the show with news making the rounds in the world of the capital markets, and we'll take off with the Debt Management Office, which says that the country has a subsisting debt management strategy in contrast to some media reports. In a statement released midweek, the Debt Office explains that a robust strategic plan became necessary due to developments in macroeconomy, and that's the Economic Recovery and Growth Plan, which aims to fund the government in the face of lower revenues. The DMO reiterates that the debt management strategy, which is being fully implemented, was approved by the Federal Executive Council in June 2016 and has an expiry date of December 2019. And mid-level Nigerian banks will grow their earnings materially over the long term, but the operating conditions will remain challenging over the next 18 months. That's the bane of a report released this week by Moody's Investor Services, headquartered in the United States. Moody's listed Fidelity, Union Bank, FCMB, Sterling, and Diamond Banks as the Nigerian financial institutions that show solid earnings potentials, but remains in need of recovery from the 2016 economic recession. The report says that the Nigeria's Tier 2 banks suffered more severely than the top 5 largest banks from the 2016 recession and are still recovering. Moody's see Fidelity Bank, FCMB, and Union as the best positions to weather the current operating challenges, while Diamond Bank faces greater headwinds of bad loans and modest foreign currency liquidity. Now, Nigeria's mortgage refinance company, NMRC, plans to seek approval from members by the end of July to triple the size of its debt program to 440 billion naira. The government-backed mortgage agencies hints that the notes could be issued through non-convertible loans and bonds, either through public offering, private placement, or a book building process. Last month, the company announced the completion of its 11 billion naira, 13.8% Series 2 bond issuance under the 440 billion naira medium-term notes program, which is oversubscribed by 200%. The NMRC is a mortgage-backed guarantee company set up in 2013, partly with World Bank aid, to boost lending through a creation of secondary housing markets for the alleviation of housing deficit in Africa's most populous nation. And it's now time for us to review the market numbers that traded or crunched this week, beginning with the smallest part of the market, the unlisted securities market, which is the NASD OTC, representing the national over-the-counter market for general dealers in the Nigerian capital markets. We'll start with that, where the USI boxed the 3 weeks of losses and ended at 662.89 points, moving away from the 651.69 it had recorded in the previous week by 1.72%. The market capitalization closed at 448.6 billion naira, having also moved up by 1.72%. Total volume of trades this week declined by 45% to 780,560 units of securities traded on that platform at a value of 63.56 billion naira, increasing by 90%. However, the deals fell by 19% to 61 this week. Now let's take a look at the fixed income markets. Generally, yields in the Nigerian fixed income markets remained flat this week, shedding a meager 1 basis point week on week to close at 13.21%. And at the both ends of the curve, the story differs. On one hand, short-dated yields dipped 37 basis points to 12.58%, largely reflecting strong buying sentiments and calming the buoyant liquidity in the system. However, persistent sell-offs by offshore players at the long end of the curve pushed bond yields higher by 34 basis points to 13.84%, which more than offsets the bull run at the short end of the curve again. And the numbers on the screen, looking at the bonds figures, they represent the trading numbers for yesterday at the FMDQ OTC, which is also the secondary market of the Nigerian capital markets. Number of deals traded, number of deals was 51 with a total value of 9.35 billion naira, and that represents the trading on the federal government's bonds, but not without the transactions that was seen on the April 2037 bonds, which had a price of 113.25 naira, that's 113 naira 25 kobo basically, and a total value of 2.1 billion naira. That security had 13 deals with the February 2028 and July 2024, 2034 rather, securities. The March 2027 security also had some good sentiment from investors. And if we should reflect the yields reports that we had earlier and on the treasury bills markets, but with the FMDQ, which is the secondary side of things there, we have the July 2018, July 26th and 19th of 2018, as well as the 18th of October 2018 securities, attracting some trades now from investors there. Number of deals was 616 in terms of what we can see from on the screen right there, and that's coming in from the FMDQ OTC. We also have total value of transactions at the treasury bills ends of the market yesterday, FMDQ at 154.40. Now let's move on to the equity markets, where the key benchmark index reversed last week's gains to decline by 1.71% week on week and closed the week at 37,625.59 points. Now the decline was largely due to the negative performances in Forte Oil, which declined by 19.79%. Lafarge from the industrial sector came low at 4.76%, while Nestle shed 4.76% as well. Zenith Bank closed down 2.80%, while Nigerian breweries from the brewery subsectors ended at 2.71%. Unilever was also down, as well as Dangote Cement from the industrial sector as well, shedding 1.71%. All of this contributed to the volume, the value of trades that we saw at the equity markets yesterday, Friday, 6th of July, 2018. In terms of the sectoral performances now, the oil and gas was down 5.69%. We have the food subsector, as well as the consumer goods sector coming lower at 3.47% on a weekly basis. The brewers, which was also reflected now in the performance of Nigerian breweries, was down 2.49%, while the cement sector, as we saw now in the prices of Lafarge and Dangote Cement, shared 1.94%. Those are the sectors that closed in red, offsetting gains in the industrial sector as well as the insurance subsectors now in the Nigerian capital markets. But so now let's join our analyst, Mr. Ayodele Akinwumi, by phone to take a look, to take us through basically what we have from the merchant bank regarding the reports it posted recently. It's been consistent with varying degrees of findings in the Nigerian capital market, giving us reports left, right, and center in terms of what areas you as an investor, whether institutional or retail, could be investing in. We understand we can't join Mr. Akinwumi Ayodele yet on the phone. We will then look at the comments of the Nigerian magnates who recently said that, who is actually raising commercial papers of 150 billion naira in the Nigerian capital market. According to earlier reports, it says Mr. Aliko Dangote is looking to offset his debts to the banks. But speaking recently at a function, the magnate explains that the Dangote Cement as an entity is only testing the waters.
We have as a company a very, very low debt operating company, and we wanted to also test the market because you can see that our rating is a little bit above Nigeria's sovereign rating. So we just want to try and see how we can raise funds if we want to raise funds for expansion or for acquisition. We already have companies all over Africa, almost about 16 African countries so far. And we are not borrowing much, and we don't have much. This is the first commercial paper we ever raised in Dangote Cement. So, you know, it's very good, and you can see that within a day or so, we got results of over 50 billion, almost 100 billion in terms of demand, but we only took about 50 billion.
Mr. Aliko Dangote, Africa's richest man there. Let's take a look at the African markets, where all the markets that we track came in closing in the red this week. Johannesburg Stock Exchange, the all-share index fell by 0.5% to 57,314. Most of the markets we tracked, like we said, came in closing in the red. A disbursement of $250 million tranched to Tunisia for deficit control failed to lift the northern African market into the positive territory. This disbursement represents the fourth from Tunisia's loan program tied to economic reforms and brings the IMF's facility in that climb so far under the 4-year program to $1.13 billion in that country. And looking at the weekly numbers, once again, the Nairobi Stock Exchange, which represents Kenya, had 173 points in terms of the index performance there, closing lower by 0.8%. The Tunisian markets ended at 8,098 points, having seen a loss of 0.5%. In terms of the Francophone markets, headquartered in Cote d'Ivoire and known as BRVM, that index came closing at 219, shedding 1.2%. All of these sell-offs in the sub-Saharan Africa represents the kind of sentiment we have been seeing in the global markets, where trade wars, as well as the strong dollar and the high interest rates in the United States market, is having on the local market here. Now let's go on this short break to pay some bills, and we're back in a moment.